Okay, welcome to the Bob Unger Show, which appears on YouTube and on BitChute.com. And I'm very privileged to have as our guest today, Michael Oliver. Michael is a very unique guy because he's not only a fabulous technologist in terms of technical analysis of the markets, but he also has a great working knowledge of the bigger picture. And I think we need these days to see both. And Michael, give us your website and your company name and a little bit about your background and how you started out and got to the point you're at now.
Sure. Momentum Structural Analysis, or MSA, is our research company. We've been in existence since 1992. In the first decade or so, we only serviced provided research, our own unique brand of technical research to institutions like hedge funds, mutual funds, banks, and so forth. But in 2014, we opened up to the general subscriber public. And our website is www.olivermsa.com. And if you go to the site, you can find an explanation about our background and our methodology that more or less simplifies what we do, which is greatly different from most technicians that you see market letters of or see on TV. I won't get into that, but the site provides that information. We try to anticipate primarily macro trend changes before they occur so that you get the idea that something is about to change trend before it happens, so you have some heads up. And you are able to position yourself in a given market. We look at all the major asset categories: foreign exchange, stock markets, commodities, gold, etc. So that you can get positioned before the violence begins in the new trend. And so you get positioned with a good risk-reward ratio. We also then will look at a trend ongoing with intermediate downturns. We try to anticipate those, but we don't want to scare people out of the big trends. Too many market letters out there are full of hype and spook, and they may be bullish on gold, but they tell you to get out 4 times in a given year because it's making a top, et cetera, and meanwhile they miss the move. That's not our goal. How did I get in this business? Well, I got in the futures market side. I was hired by E.F. Hutton in 1975, shortly after gold was legalized. It was legalized in January. I joined Hutton headquarters in New York, commodity division, in April. And how did I get in that? My background is certainly not finance. It's not technical analysis. It's political philosophy. And I basically gave up on a potential career in political philosophy, academic career. I was at University of Hawaii working on a PhD, and I'm of a libertarian background. In fact, I was involved intimately in the original US libertarian movement back in the late 60s, early 1970s. I was editor of a publication called The New Banner, which was the country's first objectivist/libertarian newspaper. And in the process, I met some interesting people like Dr. Murray Rothbard, who was effectively the father of the modern libertarian movement as we now know it, which, unlike libertarianism 50 and 100 years ago, which was considered socialist anarchism, he was an advocate of capitalism, but also of a limited state variety, or in his case, no state ultimately. But anyway, trying to pursue that career was a waste of time in 1974, because if you recall, that was a global recession, depression, and even universities weren't respecting tenure that much. And I said, phooey, I'm out of here. A friend of mine had joined Merrill Lynch in the futures division there. I joined Hutton, and sure enough, it was a good move. Gold, of course, was my enticement, because gold, as we all know, is the money of the world. It has been, always will be, unless we end up on another planet and there's another metal. And it was legalized in early 1975, largely because of the lobbying efforts of some libertarians in New Orleans, committee to legalize gold. And they managed to get it through Congress, and it passed. And so that's why we have gold today. And frankly, most people don't know this. It was libertarians that got it through Congress. Anyway, so I shifted career then, And I was with Hutton from 75 through the next 5 or 6 years. I rotated different firms as a futures broker, but I'm not a salesman really. And so ultimately I shifted into research because I was enticed by Wachovia Bank, which was headquartered at that time in North Carolina, and I happened to live there at that time. They'd heard about the nature of my work, and they asked me, would I provide soft dollar research? A soft dollar is when a fund manager or a bank trust department generates commissions in managing their accounts, and some of those commissions can be paid back for research through the brokerage firm to which they execute the trades, then can pay the research provider. Complicated issue, but that's how we got started. So anyway, we live now in a very interesting time, and you know that, Bob. I argue it's probably the most interesting time in markets and in political and economic and social trends that we've seen in a lifetime or two, and that it's likely to rapidly progress in directions that most people can't anticipate and don't even have the terminology to apply yet. Chaos theory. In other words, we normally think of trends being incremental, you know, where let's say a market goes up steadily and evenly and you can draw lines and so forth. And also social and political events tend to be incremental. They take generations to change. I think we're in a time period now where between now and next year, for example, over the next 12 months, you could see changes that you would not have anticipated at all a year ago.
Yeah, I heard you recently doing an interview with our mutual friend Jay Taylor. And I was very intrigued by what you said, because as you know, we now have a totally polarized population. We have the Republicans who think the Democrats are the bad guys. Then you have the Democrats who think the Republicans are the bad guys. And you and I both think both sides are the bad guys. And so it's a very confusing maelstrom we have there. And you made the statement that Donald Trump has done more to destroy free market conservatism, if you will, than just about anybody else. And could you explain why you say that?
Well, he has certain slogans and policy directives that he pursues that seem to be conservative. In fact, you know, you can interpret them as being conservative, like certain reductions in regulations and attempt to cut taxes a little here and a little there and so forth and so on. So it sounds like a conservative, but there's too many other aspects to him that are contradictory to that in major ways. He doesn't, for example, while the Democrats or the left would want to spend more money on social programs and so forth, Trump wants to spend them on infrastructure, which is quite popular with the left as well, but also defense spending. You know, he's racked up defense spending like it's not been in a long time, and he takes pride in that, as if we're at war with somebody. We're going to be at war. Perhaps that would help him. I don't know. So he's really a split guy, but too many people interpret these micro things that he's done, like reduction in regulations and cutting certain departments here and there, as being conservative. Well, then explain why is it that so many congressmen and senators on the Republican side since the Tea Party days, who've been around for, you know, multiple re-elections and been elected and elected over and over, have decided to resign or to not run again in the last year or two, and especially this year. It's because the party of which they're attached is no longer the party that they were part of. It's been co-opted. It's now the Trumplican party. And the old party of Reagan, remember Goldwater, his ideas, he didn't get elected, but his ideas did permeate the party. That party's really gone. It's now the Trumplican party. If you're not with Trump, you know, you're an enemy. It's not if you're not with conservative ideas. Well, I'm not a conservative. I'm a libertarian, and a lot of things that conservatives do, I do appreciate, understand, but he has co-opted the party and effectively destroyed it. Now, then when we go to the other side of the equation, and I'll talk more about the major destruction that I think Trump carries on his shoulders, but the other party has gone in the direction they normally have been headed since, let's go back to LBJ, like 70 years or so, a little before him. But remember the war on poverty, Well, that was a great success, but it began an ongoing social welfare system that has grown and grown. And if you look at it over the decades, it really didn't matter in terms of the growth of statism. Whether it was a Republican in office for 48 years or a Democrat, it oscillated like two snakes writhing around the totem pole, okay? You still ended up with the growth in the state regardless of the chatter on one side or the other. So somehow that happened. And Trump has not changed that. Now the Democrats are faced with the likelihood of victory, which I'm sure they're relishing. And but the people in the party, let's forget Biden. He's transient. He's just he's pleasant enough. He's not irritating, so he'll do well on TV. Because unlike Trump, who's somewhat irritated almost any time he's on TV, whether it's a happy irritation or a negative one, Biden comes across as like your uncle or something. So to some extent, people who want comfort in their life at this point in time and don't care about ideas as such, they don't think about those things. He exudes comfort, more relaxation. So naturally, he's going to garner that vote. But the people waiting in the wings in his party are of the further left than they've ever been. And they're going to inherit that success. So that you're going to have a Congress probably in 10 weeks, we'll know, which has gone fully left, more so than we've ever seen before. AOC might become Speaker of the House or something. Which case, if they control the House, which they do now, and the Senate, anything they want is going to get passed. So any assumptions you may have had about the political direction of the United States, you can toss them, because we're going back to full, loving state socialism. And I think that's where we're headed politically. I think that's where we were headed anyway. Now, let's go back to Trump again. Of anything that a president or a leader of any country can do that is negative to society, aside from dropping a nuclear weapon on them or mass murder, it's destruction of the money unit. And Trump has all along been an advocate of destruction of the money unit. He won't use that term. He wants the Fed to cut rates to zero and even below zero. He said this a year or two ago, to compete with the Europeans and the Japanese, which are already down at the zero level. He thought we should compete with them. He wanted them to print more money, stimulate through monetary policy. And the Fed was somewhat reluctant and finally joined, because of recent events, joined in his desire for that degradation of the money unit. That, I argue, the money unit is the most destructive thing a government can do if it facilitates the destruction of the money unit, as Trump is doing, and now the Fed is doing, on a competitive basis with the ECB and the BOJ, even more so than they are. That's what the dollar increased on that we are now more aggressive in money degradation than these other central banks. Well, Trump can take credit for that. And that is effectively modern monetary theory. I mean, even Mnuchin said recently regarding the budget deficit and a lot of the spending that's going out to assist people who are hurting. He says, budget deficit doesn't matter. Okay, this is coming from Secretary of Treasury of a, quote, conservative president. Had this come out from a Bill Clinton Treasury Secretary or an Obama Secretary, the Republicans would have gone nuts decrying what that Secretary of Treasury said.
And for the benefit of our listeners and viewers, modern monetary theory, or MMT, is something advocated by AOC, correct?
Correct. And I don't know why he doesn't have her on his board of advisors. So she wouldn't join, that's why. But so that's the biggest thing. He can do everything he wants. It seems to be conservative in a little limited way here or there. But when you factor in that one issue, that is the most destructive thing. Why is it destructive? Well, monetary expansion using M2 from the Federal Reserve data, going back to 1959, every decade the money supply in the US, M2, has almost doubled. It's more like about 95% increase in the monetary units that are out there every decade. That's been a constant. Now suddenly we're doing that about every year or even less time, because you should see the M2 chart. It's like a rocket. That has consequences. What are the consequences? Well, the consequences are both macro and micro. And by micro, I mean, family. The family tried to make plans about, what do we do with our savings? Do we save or do we not save? Another destructive force, for example, is, let's take Ben Bernanke. He gave a speech and wrote a paper about the stock market in 2003, 3 years before he became head of the Fed. He was on the board of governors then, effectively saying that rather than just affecting interest rates, the Fed needs to focus on stimulating the stock market. And he said the positives of that is it causes consumers, when they see rising stock prices, especially if they might own some stock, to be more spending than saving. And he thought that was a very good thing because it stimulates growth, causes companies to make more products, et cetera, et cetera. So he outright stated in an academic paper that he read as a speech in October 2003 that the policy goal of stimulating the stock market should be part of the Federal Reserve's direction and impetus. And sure enough, it has been. He did that in 2007, 8, 9. It didn't work, but then it worked in 2009. They're doing it again now. And that's why we've had the bull market, in our view, that lasted from 2009 through 2020. It's not a driven by reality type market. It's driven by monetary stimulus, especially now. Ultimately, if you destroy the money unit, if you degrade its value, what you're doing is you're taking a unit of measurement that people use to predict their future, to plan their future, companies, state governments, pension funds, individuals. And if that money unit changes its value, but keeps its nominal value, so that let's say you own a stock that's at $30 3 years ago, and it's $35 right now, you think you've made money. No, you haven't. The money unit degradation surpasses the growth you've seen in your stocks. In fact, you've not made money in terms of the number of money units to purchase the stock. That's like having other units of measure that human beings use in their daily life or in their scientific life. Measurement of light, measurement of temperature with a thermometer, a yardstick. Let's say you're a builder of homes and you've got a contract to build a home. It would take you 6 months to do it, let's say, a big house. And you got your yardstick says 36 inches and you start. And over 3 months, your yardstick says 36 inches still, but it's actually grown a couple inches, but it still says 36. And you're still making additions to this home and so forth based on that unit of measure. Well, you can imagine what that home's going to look like at the end of 6 months and how unstable it would be. Well, translate that into your money unit. If your money unit is distorted, then you can't make financial predictions in any reasonable manner with a money unit that doubles every 10 years or now doubles every whatever number of months. That destroys the fabric of human interchange, because when you buy something from somebody, a service or a good, you're in effect applauding that person. You're saying thank you, but you don't know them. It might be over the internet. It might be from a distance, but it's the social order between human beings or companies. And if the unit of measure that's used in those transactions is decaying and in fact false, then those transactions are ultimately not as stable as they seem, and it could disrupt society. And I think that's what we're now seeing. What if, for example, instead of Bernanke's wish coming true, that people would spend and be consumers and not save, which has in fact been the case for the last 10, 12 years. We know that via various metrics. Number of households that can pay, for example, emergency money. You know, that was $400 or $1,000 a month. That number is escalated dramatically who cannot afford emergency payments. What if we'd come into this crisis with a population that had, in general, let's say 6 months of savings in their pockets instead of 1 month of savings in their bank account? Then if they were laid off or their income was cut somewhat, they would have some cushion. So in effect, as soon as this began, so much of the population was already without cushion. Part of the Fed policy, stimulate growth by having consumers excited by the stock market and spend instead of saving. That's the kind of reality that Trump has helped facilitate. And if had it come from a Democrat, a lot of Republicans would be screaming, but they're not. And so that's
No resistance. No resistance whatsoever.
Yeah, correct.
Touch on this. You know, you hear a lot, mostly from the Democrats, about quote unquote income inequality. And explain to our viewers how this type of monetary policy, pushed by Trump and of course also pushed by the Democrats, as I call them, how does that affect the destruction of the middle class and the wage earner in this country?
Well, I mean, they're in economic events. It's not just macro; it's also micro. So all of these things can be affected by many other variables that come from one policy, for example. Uh, but right now, let's look at income inequality. I suspect it's more exaggerated now than it's ever been, despite the depths of the depression we're in. Uh, those who have large stock portfolios, and of course we know that's not the average middle class family, or certainly not the lower class, are feeling quite good right now. Their separation from the middle class in terms of disposable income, money in their checkbook, et cetera, has gone off the page, whereas the average family is still suffering from issues like, well, can we pay the rent? Can we buy food? Issues they've never had to deal with in their entire life or career. They suddenly are having to think about, gee, where am I going to get food next week? They're going to food banks. They're driving up.
The average Trumpette will argue with you from the cheerleading squad that it doesn't matter because the middle class has all 401ks and therefore it makes them wealthier.
Well, to the extent that their 401ks are sizable, and to the extent that, well, first off, don't expect them to continue to grow. I know Trump is counting on that. But I'll go back to our technical side here. MSA anticipated the downturn without knowing about any virus. I think the virus is a screen, actually. It's a very deceptive event that will damage many people more so than the virus itself, because it's encouraged them to believe, as Trump would like you to believe, that the market downturn was only due to the virus. There's no underlying vulnerability. He's made things better. And therefore, it was only the virus. And once the virus is over, everything's going to go back to normal. No, it won't, because we have a debt crisis. That's always been there. It's gotten worse over the last 12 years. The virus is merely the ripping off of the scab and revealing the debt crisis. As I alluded to a minute ago, the family's ability to weather something like that is like non-existent. Too many of the people buying the stock market now who are benefiting from it think that, oh, when this is over, we're going to skyrocket to new highs. We argue that no, there's already a shift in investor preferences toward other assets that are safer, more on the ground rather than in the stratosphere, such as commodities. And that the input of new money by the Federal Reserve, the ECB, and the BOJ, and all their policies combined, this time around will not benefit their bond markets or their stock markets. Instead, it will benefit other asset categories. And now if commodities rise, food prices, what's that going to do to the poor folks, to the middle class folks, as a percent of their monthly expenditures? It's going to go up dramatically, we think. And their 401ks will cave. So MSA, we anticipated the downturn, and before it occurred, we defined it as a crash. And the reason we did is our technical analysis showed us that if the market then in late 2019, as it was making new highs in the S&P, had built momentum trend structures, the kind of things you see on price charts, but were not apparent on price charts. We saw them in our momentum charts. That if you did come down just a little bit off those highs, you would be breaking structures that went back 10 years, like a floor. And we knew that when we broke that, whatever the excuse was, that the downturn would not be gentle, it would be a crash-like event. And sure enough, it was. It was the same dimensions as 29, it was the same dimensions as 87 in terms of percent drop over a matter of weeks. Now the recovery is different. And this is what's fooling people, including these people with 401ks who are feeling good now, let's say, or at least hopeful that that aspect of their life is safe. We called the upturn one day off the low in March, late March, one day off the low. We said, okay, if you're short, you better get out because they're going to inflict pain on you. And sure enough, they did. We've not gone back to a negative stance since then, but we're about to. We think during September, we'll likely get a renewed downturn. Now, not that it has to be crash-like, but a renewed downturn in that asset category, stock market. What will that cause the Fed to do? Be even more aggressive than they are now, because it's not just the virus, it's the stock market. So if the stock market goes back down And probably we'll see some of this before the election, which will hurt Trump, of course. Then the 401kers that are relying on that, or the pension fund holders in the state of Illinois, or some of these other states that are in dire straits in terms of being able to fulfill the pension fund commitments, are going to be screaming. So that 401k issue you brought up for the middle class, that could become a very big negative, and probably very soon. We can't afford another downturn. And I suspect it's going to come. It's just a gut assumption, with some positive news about the virus, meaning they've actually got a vaccine or something is on the horizon. And so then these folks were bidding up stock prices thinking that's all it was ever about. The downside was due to the virus. Therefore, if the virus has a horizon, it's going to go away. Everything's good again. That's when they get surprised by a market downturn for the real reasons, the reasons we've already discussed, namely the debt crisis. And at that point, then the middle class, which to some extent has one good thing going for them, their 401k, will not have that anymore. And they won't be able to blame it on the virus.
I've been hearing rumors that on Thursday at the quote unquote virtual Jackson Hole globalist conclave that they have there, that Powell is going to speak, and that he's going to announce that they're going to stop what they call inflation targeting. And I wanted to get your thoughts on that.
I'm sorry, did you say inflation or inflation?
Inflation targeting, that he's going to end and let inflation run, as they say.
No, well, he's going to get it. Now, see, our problem is this. Intellectually, most people think of inflation as commodity prices, or CPI, let's say, which includes some other things other than commodities. But we think those are meaningless notions. Inflation can show up in any different area, asset category, depending upon investor preferences. So the river flow of money comes from the central banks, but then the investors, large investors on down to small, can shovel that direction of that river flow in different areas. For example, in the 1970s, we went through a global recession, stagflation it was later called, where the central banks were quite stimulative, but it didn't go into stocks. Stocks were a wasteland. If you invested in the stock market from like 1975 to 1982, you got the zip. You had teases ups and teases down, but it basically was a non-performing asset, whereas commodities went off the page. Investor preference shift. There is evidence of that now. We see it in gold. We argue at MSA that we're about to see it in the Bloomberg Commodity Index. So if you measure inflation as only commodities, yes, it's been very low, well below the Fed's, quote, 2% prior target, which now they don't have a target. Instead, it's gone into the S&P 500 and the NASDAQ 100. If you look at those charts, those reflect inflation, meaning where did the money units go that they created? Went into the stock asset category. That is inflation. Monetary stimulus created price increases, way beyond what might normally have occurred in a real world. If that shifts, then he's going to get his inflation by the normal false notions of what inflation is, namely just commodity prices. But the commodity prices are going to hurt people. So if their stock assets stop going up and instead go down, don't even have to crash, just go down some, and commodity prices go up, then the middle class is hurt on both ends by a ceiling and a drop in their 401ks, and by an increase in the cost of food or of anything, gasoline, rubber tires for their car, price of rice, you name it. It's going to go up. And we see the technical wherewithal that that's going to occur, and likely we're going to see the evidence of that pretty solidly between now and the end of the year.
Do you think that currently we're in a recession, a depression, a hybrid, a buffet of things?
Depression.
You think we're in
I think we're in a depression, and I think we've actually been in them before, but nobody wants to call them that. 2008 and 9, I mean, they printed their way out, but that was, if you took the state of Texas out of the United States in 2009, because it was doing fairly well, we would have been by all metrics in the United States depression.
And what are your metrics for the word depression?
I don't. It's hard to put a number on it. It's just that I see now the technical damage is not just going to be isolated to one stock asset category. For example, in 2000 to 2002, it was primarily the .com or the tech stocks. They went down like, 90%. whereas the overall stock market went down 50%. We think this time around it's going to be wholesale, meaning all asset categories within the stock market will be suffering. It won't just be isolated to one little bubble area. Now, true, right now the a limited number of tech stocks, big name, Microsoft, Amazon, Apple, are leading this move. And they're carrying the S&P 500 and the NASDAQ 100 upward with them because they're so heavily weighted in those indices. So the S&P 500, like 25% of those three stocks. The NASDAQ 100, it's way over that. So we're getting a distorted view. But when those markets turn down, we also examine such sectors as industrial sector, not bubble stocks at all, the banking sector. But look at the banks, for example. Do you know where they are right now? They're below the December 2018 price low. Remember the December 2018 sell-off? Very sharp drop.
On the interest rate increase.
Yeah, S&P dropped down into the 2340 something level was its low. Okay,
based on the quantitative tightening at the time.
Right. Bank stocks are below that price level. It's as if the S&P now, instead of being near 3,400, we're about 2,100. That's where bank stocks are now. Nobody's talking about the bank sector. And it's not just bank stocks, it's the financial sector broadly is also at price levels below the December 2018 lows. And if you look at them on a relative performance basis, we're getting a little academic here. What we do is we measure the banking sector value versus the S&P. In 2009, we all know that what led the decline was the financial collapse, therefore financial stocks. The relative performance upturn since then was non-existent in the banks. Yes, their price went up, but their percentage of value relative to the S&P never came off the floor since 2009. Despite the big rally in the market, their relative performance did not increase. They did not go back to the relative levels that banks held in 2005. We're now lower on a relative performance basis in the financial sector than it was in 2009. That speaks of fundamentals. So we're talking sectors that have nothing to do with bubbles, that are still in very depressed looking status technically and fundamentally. The auto sector is another example. They were already in a major downturn well before this top occurred last year, 2000, and late 2009, early 2020, 2019, 2020. The auto stocks were in a slide. Their sales were collapsing. Their stocks looked like hell. They're even worse now, but nobody talks about that. So all kinds of sectors that have nothing to do with just the tech sector have gone down or are staying down. So to us, that says now the illusion that this was a brief recession is false. We haven't even begun. We think the entire thing will go down. And we think at the same time, certain other asset categories will go up, namely commodity and commodity-related stocks.
And what about Trump running around saying that this is the, quote, greatest V recovery of an economy in the history of the world?
Well, a lot of that was based on his stock market assessment, but I can do the data, anybody can. Go back and find out when Obama was took oath, when he got left office, and see how much the S&P gained from when he took his oath and 8 years later. I think you'd be quite impressed. Now, the question I have is that, and it also, unemployment recovered big time. No, it recovered. Unemployment got better under Trump. That's true. But between the low in 2009 and the unemployment numbers when Obama left office, it's a pretty big move. So was the stock market. But do you see Republicans applauding the Obama stock market? No, I never saw any.
Not Obama or your mama.
So it's very selective, very narrow, and Trump doesn't have any concept of how unrelated the stock market is to economic realities. And that's why from time to time we see stock market do things that just fool most people, namely go from enthusiasm to total destruction in a matter of a year or so. Because one, the enthusiasm should never have occurred in the first place. That's part of the reason for the drop. And then they always overshoot on the other side. Well, we think we're in that position again where it's now time, if you're in a 401k in the middle class, to be thinking about putting something else in your 401k than stocks.
Well, when you do your work at MSA, you kind of forget about the emotion and you forget about the news headlines every day. You look at momentum. And for a technical dinosaur like me, who's nowhere near in your category of knowledge of technical analysis, explain as best you can to those who are not already versed in this, how it is that you analyze the markets.
I just argued that money units, degradation of money units, the dollar, how many dollars are in circulation this year versus last year, how many euros, how many yen, and so forth. Pardon me, I have a little drink of Perrier here. Those degrade the real value of certain assets. And so you can't really measure that well when you just look at price. Now, over the short term, yes, the money growth doesn't necessarily affect the price of this stock 6 months later. But when you go back 2, 3, 4 years, the money growth has definitely affected the value of all assets. They would either be lower than they are now or not so high as they are now if it weren't for the money growth. So it's distorted all assets. Instead of looking just at price, which most technicians do, we take price and we measure it against certain means or moving averages. And I don't mean we simply lay a moving average over the price chart. That's simplistic and it doesn't really help much. You can crisscross a moving average, a 200-day line, for example, and it's next to meaningless. It's a 60-40 odds that it means anything. What we do is we plot a chart, and again, you can see this on our website, olivermsa.com, under the method category. We plot the price of the action of a stock or an index in its relation to a given moving average. We look at long-term moving averages like 10-year, 3-year, 3-quarter moving average, 3-month, 3-week, etc. So we look at short-term and long-term in terms of what is this stock price doing in relation to its own moving averages. So to some extent, we separated a bit from just measuring it against the money unit. We measure it against the money unit, but also affected by its own moving average, which is affected by the price movement of the stock. So we've taken a step away from simplistic price chart analysis. And because our focus is largely on longer term, meaning what's going to happen over the next 6 months or a couple of years, not what's going to happen over the next 6 weeks or 6 days. And we therefore will flip direction. For example, we've been as bullish on stocks. We've called every major low in the stock market. 1994, we predicted a major blow-off. Of course, by 2000, we had one. 2000, we called the top. At 2002, we called the low. Took a while to get going in 2003, but it finally did. We called the top in 2007-8. We called the bottom to the week in March of 2009 and got very bullish, used words like major bottom. So we do flip-flop. Same with gold. Even though I have an intellectual love of gold for my libertarian core reasons, we also know that gold goes up and goes down big from time to time. In 2011 and especially January 2012, gold had dropped 100, 200 bucks off of its high. It was in the mid 1600s. We declared a major top and we did not change our view until the market hit its bottom in late 2015, early 2016. Then we went major bullish again at $1,140 gold. So we do flip-flop. So in other words, what we've been talking about my background or my views, we do not allow those to affect our conclusions, our technical conclusions whatsoever. Right now, it just so happens that our fundamental view, which we don't usually even include in our research reports, happens to match our macro technical view. Namely, there's a shift in categories. We're about to see stocks go down again. We're about to see commodities go up, which will surprise a lot of people, especially the Federal Reserve. They're going to get the inflation they want. And thank goodness they've taken the leash off. I don't know how far that leash is going to stretch this time before they finally realize that, oh my God, 2%, we got 20%. We live in fun times.
You mentioned moving averages a few minutes ago. Do you view gold as being stretched too far above the 200-day moving average right now?
No. It's not just an issue of how far above or below, because there are times, if you go back and look at gold, many bull markets, not many, but several bull markets it's had over the last 50 years. It's been way higher than it is right now, for example, in relation to its 3-year average or 36-month average, which is generally our longest term metric that we look at. We also look at 10-year, but right now, in no manner is gold too high priced in relation to its own long-term moving averages. It's not even comparable. We're double digits above our 3-year average, whereas back in 1975, when we had our bull market and gold was introduced in the futures markets, price was at $200 when it peaked. It was 250% above its 3-year average at that time. Nowhere near our current levels. So no, I don't think so. And also, rather than looking at just how much above or below, we look at trend structures, meaning when you look at a price chart, people look at trend lines. They look at floors on a stock. And if it breaks, they consider a structure to be broken. We look at the same type of things on the momentum charts. So rather than just looking at how much above or below is this market in relation to a mean, it's, are there any structures to break through to cause a new trend shift in the other direction? And if we don't see anything that's obvious, meaning let's say a good downtrend line on the momentum chart, or a ceiling, or in this case in gold, do we have a floor underneath that we've used and used and used, that if we break it, it will go down? We don't. And when you usually do not have a momentum trend structure to justify a trend change, you won't get a trend change. It's not until momentum is developed, the obvious, the new trend direction structure, the starting gate, if you will you then get a trend change. And right now, gold is not in that position. Couldn't get a short-term sell-off. We already got one. We might get some more. That's a debatable issue. This coming week will tell much in that regard for us as to whether there's any more in this pullback or not anymore. But even if there is any more, we consider it to be minor disturbance and the kind of thing that will knock people out of their solid positions, which is long gold.
What is currently the 200-day moving average?
See, I'm not sure where it is right now. We don't look at the 200 days so much as we do the 3-quarter. And right now we see support on the 3-quarter moving average at about 20% above it. And our recent lows have pulled back to that general level. In other words, if you looked at a 3-quarter moving average, which is very similar to a 200-day, by the way, if you think of the time duration of 3/4 of a year, 200 days, gold had a dual ceiling there. It had 19% over and about 19%, blew through it 2 months ago. So and then it surged. And so far, this pullback is just sitting on top of those old momentum highs, which are not at high levels in the first place. So from a momentum perspective, we see this gold pullback, but it gets back into the 1800s is fine. It did that 2 weeks ago. Is sitting on top of likely support. Not evident on the price chart, but evident on the momentum chart.
What do you see price-wise? Not to put you on the spot, although I'm doing it. What do you see short-term downside? What do you see in the intermediate term, and more difficulty long-term?
The short-term, in our weekend report we're about to issue, we explain that we think this coming week's action could be very interesting because if gold, which has had a pullback from its intra-week highs of 2 weeks ago, basically it had a 1-week drop 2 weeks ago, and then last week it dropped $1. Okay, the weekly close last week was $1 lower than where it was a week before that. And yes, we're off the high. The spot high was actually 2070. And we're 1934.6 last Friday's close. So we're well off that high, but we're not breaking anything. And intra-week, 2 weeks ago, gold actually dropped into the mid-1800s in a very quick stab. It's possible we could go back there again, but we think what happens this coming week, again, we're talking short-term now. For instance, we see some potential this coming week for gold to firm back up to the upper 1900s, maybe 2000. If it does that, we're not sure there's going to be any more break. That's a short-term analysis, and effectively that's really meaningless because we're arguing this is a major trend in gold. This is not just another big bull trend in gold. This is a different one, qualitatively. This is probably the final bull trend in gold because we think on the other side of this situation, you'll have trend collapses in other markets that will cause a vast rethink among developed markets especially, maybe even less developed markets, as to what monetary policy should we have had in the first place. And we think there will be a reversion back to gold-backed currencies, in which case gold will be back in currencies rather than being outside of the currency world, in which case you'll have currency stability instead of government manipulation of the money units. That's a whole totally different world. But in getting there, you might have a great crisis because of certain asset categories coming under great pressure or going up a large amount. And we think that's going to be gold and commodities, stocks, and then ultimately government bonds to the downside, meaning higher yields. Okay, let's go to intermediate in gold. Intermediate, meaning 3 to 6 months. We suspect by the end of the year, gold is going to be pressing to the upper 2000s, meaning just under 3,000. It's not an important level. It's not an ultimate peak. We just think that's probably where it's going to be. So if we get a fist fight here in the low 2000s, we think it'll resolve and you'll shoot up there. We also think silver will continue to lead. Silver has now shifted to an outperformer to gold. We called a major breakout in silver at $19.48 a couple months ago, and it shot up $10 in 2 months after our major breakout level. We think silver is now going to be the poor man's gold again and will outperform gold vastly on a percentage basis. We think the silver dual highs at around $50, 1975 high and the high 2011, that $50 high is coming out ultimately. Not this year. Ultimately for gold, we don't know. I mean, we could throw out a number, we could say we're going to 10,000, we're going to 50. That depends largely on other market factors, the destruction of developed market stock indices, the destruction of government bonds, which are highly inflated as well, at near zero interest rates. That when ultimately the market forces take over those bonds, instead of those bonds being still controlled by the central banks or largely influenced by the central banks, you're going to get a disaster in the government bond market. For now, the government bonds are a safe place to be. We think there's one more panic surge in the bonds, upside in price, drop in yields. But after that next surge, we think the bond market could become vulnerable. And as we know, the global bond market, Europe, Japan, and the US, if it ever got in trouble, and we could see the technical reasons for that, aside from the fundamentals, we see large technical reasons, you're going to have a crisis beyond anything the stock market could generate. And therefore, those factors, when they come into play, it's hard to guess where gold might be.
How much longer you think this gold bull can actually extend?
I'm going to adhere to chaos theory. The chaos theory does not always come into play, meaning that quite often a trend will move incrementally, either up or down, and people come to expect that somewhat orderly process of decay or increase. We think that the current markets, whether they're headed down or going to go up, could be suddenly very dramatic. And we think in 2021, you could see a lot of the move occur then, rather than saying, well, it's going to take 5 more years. We think the events as they cascade, and some of these will be social, political, and even cultural events that are being impacted by these monetary factors, so that events we can't even think about, terms we don't even use, will come into play. And when they do, all of our notions of incremental rise in gold or comparing it to prior bull markets will go out the window. And so percentage gains or gold or losses in government bonds or losses in stock markets could become so dramatic over such short periods of time that all of our notions are shot. If chaos theory comes into place, incrementalism is gone. I mean, I could throw out some terms, fundamental terms, everyday social life. Some things I think could happen next year. And there's undoubtedly many other things that could happen that I haven't even thought of. End of the income tax. Why? Because they simply can't collect it. And we know that already this year's income tax, which was delayed, didn't have a good payment response, meaning the number of filers were far less than they should have been. People simply couldn't. They said, I can't pay it. I'm just not even going to file. Hope it goes away. That type of thing. Even one of Trump's advisors has suggested we go away from income tax and go to a national sales tax. Steve Moore, I think, was the guy who said that. It was brought up, put out on the news. I think that despite Biden's talk about increasing taxes against the wealthy, which no doubt he wants to do, and all of them do, that if they have problems with the income tax process, the ability to enforce it, the ability to audit and so forth, because of the number of people who simply can't file, they don't have the money. They always did have the money, now suddenly they're delinquent. The simple solution of the state is to what? Absolve it. It's over. You pay taxes now through sales tax. That, I think, is a possibility. So think in those terms. Now, I don't know if it'll happen. This is speculation on my part. Another one, student loan forgiveness. I'm surprised Trump hasn't actually done it yet, because I thought he would do that before the election to get the student vote, or at least placate the student vote and the families that pay the student loans. I suspect student loans are going to be forgiven at some point in the next 6 months or so. Maybe Biden does it. Another thing, state governments and localities don't have tax flow that they need. They're having to lay off teachers, highway workers, pretty soon state highway patrolmen, you name it. This is a crisis. And unless their income flow through taxes increases, which it's not going to, the federal government's going to have to pay their bills, meaning the federal system we now nominally have will become a centralized funded system. Pension funds that are in crisis. If you have another stock market downturn, and especially with the redemptions of pension of 401ks and so forth for survival needs, there's going to be a crisis in the state governments in funding these. The federal government's going to have to come in and do it. We all know that the Democrats have promised to do that, more so than the Republicans will. If the Trump doesn't win, then this policy is going into effect. State governments will be backed and localities by the central government. Another term that might come up, you probably haven't heard since high school, discussing the Civil War, and that's secession. Imagine a situation in which the central government effectively destroys the money units to fund it, the states, and all the other things that need to be funded. You'll have some states that say, listen, we don't want to be part of that. We're paying too much outflow for New York or for California. So Texas says, we're out of this. It wouldn't shock me that in 2021, some states have on their ballots the issue of whether we should have a vote on secession or not. That term is likely to come up in our lexicon again. That will be a shock to many.
Well, we're running out of time, and I want to thank you very, very much for your incredibly valuable information. I'm a subscriber. I find your information extremely helpful, although some of it is sometimes above my simple head, but I keep learning, and that's what life is really about. Try to be a little smarter in the next hour than you are this hour. Tell our viewers how they can get your extremely important newsletter and how it will aid them in making their own investments.
Again, the website is olivermsa.com, MSA standing for Momentum Structural Analysis. A lot of what you ask is explained there in different categories. There's a subscription tab. We also offer a gold, silver letter only, which focuses only on the gold, silver, and the minors. But our larger subscription, which we've always produced, comes out with about a report every day. We cover all the 4 major asset categories. We look at the major markets all the time. So we're always on top of the US stock market, the gold market, the commodity markets, the debt markets, foreign exchange, because they all impact one another. You can't just focus on one. If you do, you're making a vast mistake. So we always keep our investors informed of major trend developments in each of the categories. But we don't try to absolutely tell people this is what you need to buy and buy it now, because so many markets have different venues or vehicles you can use. And each investor is different. Some want to use leverage, use futures leverage, exchange minimum margins, or they want to buy the triple ETF. We don't deal with that. We deal with the core asset itself, and then you, the investor, can go out and pick what type of leverage or not to use, how long-term you want to utilize this trade information. But we tend to guide all week by week and keep you informed about any potential changes that might occur in any of these categories, so you can integrate the entire picture, not just look at gold, for example. So we try to give a total picture. And we also, again, we try not to allow our fundamental views to dominate at all or to come into play at all in our analysis. It's strictly technical. And the technical work is over time. We find most subscribers do finally integrate the work and say, gee, this is a new way of looking at things. And we appreciate that. And thank you for being a subscriber, Bob.
Well, thank you for your very valuable